Tesla has just finished reporting their Q4 and full year 2022 earnings results, records across the board. Who could possibly have seen that coming? In this video, some highlights from the actual earnings, the financials, and then some highlights from the earnings call itself. And if you guys will excuse me for just one moment, I need to take my Athletic Greens AG1 and then we'll get into it. More on this toward the end of the video. So let's quickly run through the earnings results from Tesla before we get into highlights from the call. 16.8% operating margin, 16% in Q4. Tesla put about $4 billion in the bank in the quarter, $3.9 billion in GAAP operating income in Q4, $3.7 billion in GAAP net income in Q4, and $4.1 billion in non-GAAP net income in Q4. Tesla is literally printing billions, literally billions of dollars every single quarter. And despite aggressively growing and scaling production, Tesla still managed to increase their cash and cash equivalents by $1.1 billion, now $22.2 billion cash in the bank. And don't sleep on Tesla Energy, 6.5 gigawatt hours of energy storage deployed in the full year, up 64% year over year. Over to the summary, Q4 2022, unsurprisingly, was another record-breaking quarter, and 2022 was another record-breaking year. By the way, guess what? Same's going to be true of 23 and 24. And 25, 6, 7, 8, and 9, and 2030. I could literally keep going for years further. You guys get the point, right? Tesla's in hyper-growth mode. Just about every quarter of every year, as far as we can see into the future, will be a record-breaking quarter for everything that matters. Importantly, revenue grew 51% year over year. If you guys want to pause and read some more of the detail regarding average selling prices and the challenges the Tesla team has faced, go for your life. Importantly, right down the bottom here, no other OEM is better equipped to navigate through 2023 and ultimately succeed in the long run than we are. They're right. A couple of key highlights here. Net income attributable to common stockholders up 59% year over year. Earnings per share attributable to common stockholders, 57% year over year growth. Automotive revenues increased 51% year over year. Total revenues up 51%. Total gross profit up 53%. Tesla now with $22 billion in cash and cash equivalents. Once again, just want to remind everybody, don't ignore Tesla Energy. Storage deployed year over year growth in storage deployments up 152%. And this is before the new Megapack factory has ramped up. Model S and X deliveries up 167% year over year, and just below that, 37% growth in 3 and Y deliveries. Interestingly, Tesla including global vehicle inventory, days of supply, showing in 2018, they had 22 days of supply. In 2019, 13 days. 2020, 15. 2021, 6. And 2022, 16 days. Now, I don't know the magic number, but my suspicion is that Tesla doesn't really want more than maybe about a week, week and a half, at most about 2 weeks of inventory. Some very interesting notes regarding the delivery wave. Something a lot of Tesla Q bears get completely lost in, misinterpret, and embarrass themselves as a result. While in Q2, as in Q2, not Q4, Q2 2022, the third month of the quarter accounted for 74% of vehicle deliveries. Think about that for a moment. If everything was evenly distributed over the entire quarter, you would see 33% of deliveries approximately each month. Clearly, over the long term, delivering 74% of all the vehicles in the last month of the quarter is untenable. That number fell to 64% in Q3 and 51% in Q4. Now remember, Tesla told us this is exactly what would happen. They told us they would be unwinding the end of quarter delivery wave. They literally told us. And now we're seeing that. Of course, toward the end of last quarter, a lot of folks erroneously assumed, oh shit, wait, what? How come they produced more vehicles than they sold? Why is there more inventory? What's going on, Tesla? And what was going on was Tesla doing what they said they were going to do, which was no longer emphasizing the insane rush toward the end of the quarter to deliver every vehicle produced. No point paying expedited shipping fees, losing margin on vehicles when you can just deliver them early into the next quarter. Regarding the new factories, the Model Y production line in Austin produced over 3,000 vehicles in a week toward the end of Q4. And guess what? Same thing is true of the Berlin factory. The Model Y production line in Germany produced over 3,000 vehicles in a week toward the end of Q4 as well. Tesla massively sandbagging here with their installed annual vehicle capacity estimates. As you can see, the greater than symbol gives them a huge amount of freedom. I believe stage 1 of Berlin and Austin will both be over 500,000 vehicles per year. Shanghai is running close to 1 million units per year. But as we can see here, Tesla just saying, well, it's more than this. You'll have to figure out the exact number yourself. Once again, Tesla market share in US, Europe, and China continuing to increase exponentially from basically 0% back in 2016, now breaching 1, 2, and 3% respectively in each market. And yes, they're just getting started. Huge news regarding Autopilot and FSD. We have now released FSD beta to nearly all customers in the US and Canada who bought FSD, which is approximately 400,000 customers. On the right here, the cumulative miles driven with FSD beta seems to be increasing exponentially. I'm sure it's nothing. Energy storage over on the right here. Picture is worth 1,000 words. A chart's worth 10,000 words. I don't need to say much. Look at that growth. Beautiful exponential increase. Massive expansion in terms of supercharger locations as well. And now, the moment you've all been waiting for. Volume. This is the most important thing to focus on in Tesla earnings reports going forward. We are planning to grow production as quickly as possible in alignment with the 50% compound annual growth rate target we began guiding in early 2021. In some years, we may grow faster, and some we may grow slower, depending on a number of factors. For 2023, are you sitting down for this? We expect to remain ahead of the long-term 50% compound annual growth rate, with around 1.8 million cars for the year. This is the first time I can ever recall Tesla explicitly saying how many vehicles they intend on delivering for the full year, and spoiler alert, in my opinion, this is a massive intentional 420 IQ sandbag from Tesla. Why? We know the Wall Street analysts need Tesla to do their job for them.
Tesla, please tell us exactly how many cars you're going to deliver for the year, please, because we can't figure it out ourselves. That 50% thing, no one does that. We don't understand.
I believe Tesla is sandbagging the Wall Street analysts here. If you're keeping track, over the last handful of years, Tesla's average compound annual growth rate for deliveries is well in excess of 50%. If Tesla were to deliver 1.8 million vehicles this year and delivered about 1.3 million last year, it'd be about a 40% year-over-year increase in deliveries. For those people who are incapable of reading or comprehending the English language, who do not understand that Tesla is referring to an average compound annual growth rate of a multi-year horizon, you might think, oh,
they missed. That's only 40% growth. They missed again.
So Tesla's already spelling it out here for the Wall Street dolts who won't read it, won't understand it, and will misinterpret it once again. But because of that, they've also included a number for the Wall Street dimwits to focus on: 1.8 million vehicles delivered. And spoiler alert, I believe Tesla is massively sandbagging here. I believe this number is going to be far in excess of 1.8 million, but I believe Tesla's explicitly put 1.8 million vehicles here so the Wall Street dolts can all go, okay, that's how many vehicles we'll probably deliver for the year. I believe that Tesla has explicitly included this 1.8 million figure just to appease the Wall Street dolts, who, by the way, will assume this is what Tesla's actually aiming for. In truth, I believe Tesla will be aiming for 2+ million vehicles delivered for the full year. This way, Wall Street don't cry about the uncertainty, because at least Tesla told them 1.8. See, there's a number now. They can stick that in the spreadsheet. Between you and I think Tesla's aiming to massively exceed this number. And regarding new product, our next generation vehicle platform is under development, with additional details to be shared at Investor Day, March 1st, 2023, a matter of weeks from now. My favorite series of charts in the entire earnings report, as always, trailing 12 months. We're looking at vehicle deliveries on the left, operating cash flow and free cash flow in the center, and then net income and adjusted EBITDA on the right. This, ladies and gentlemen, is what exponential growth looks like. The trailing 12 months smooths out the lumpiness, the quarterly fluctuations. It gives us a pretty accurate picture of the overall trend. And the overall trend is to the fucking moon. Everything that matters here is growing. Now, there'll be some bumps along the road, but the trend is your friend. Over on the right here, net income and adjusted EBITDA. I mean, look at this. It's fucking beautiful. 3 years ago, Tesla making no money whatsoever. Fast forward 3 years, now stacking over $12 billion a year at an annualized rate. And they are just getting started. On the right here, Tesla operating margin versus the auto industry in gray and the S&P 500 in blue. And again, the rate of progress and the trend is what we really want to focus on. Q1 2019, Tesla had a negative operating margin. By Q2 2021, Tesla had met and was starting to exceed the automotive industry average operating margin. Fast forward another year, Tesla exceeding the average S&P 500 operating margin and continuing to climb higher. And this is a very important chart for those who are unaware that Tesla is actually continuing to drive their costs down. A lot of people concerned, oh my God,
Tesla margins are going to collapse. The prices are lower. They have less margin.
These people are not accounting for Tesla continually driving the cost of their vehicles down. As we can see, the average selling price of a Tesla vehicle versus the operating margin over time. Tesla's ASP, average selling price, is approximately halved between 2017 and 2022. Yet in the same time, their operating margin has gone from negative 13-14% to now positive almost 18%. This trend will continue over time. Tesla ASPs will trend even lower. Full disclosure, my valuation model has Tesla ASPs at the end of this decade around $30,000, a very far cry from the more than $50,000 they're at today. Yet I still expect their margins to be somewhere in the 30-40% range. And Tesla really doing the best to appease the Wall Street dimwits. Vehicle delivery growth rate, assuming 50% compound annual growth rate since 2020. Okay, so in blue, that's what an actual 50% compound annual growth rate would look like. And in red, what Tesla actually delivered. Notice, Tesla's tracking well ahead of a 50% annual compound growth rate since 2020. How do we know this? The red bars are higher than the blue bars. Notice, Tesla has put 2023 in here as well, really spelling it out for Wall Street and the finance media, who falsely claimed that Tesla had missed their target, again forgetting that it was a multi-year horizon. So fill in the blank, Wall Street. How many vehicles does Tesla need to deliver in 2023 to hit that goal? Less than 1.7 million. And how many will they deliver? I personally think it's going to be closer to 2 million. Tesla's really doing their best to make it easy for Wall Street. Read the bottom in the fine print here. Note, we expect to achieve 50% average annual growth in vehicle production and deliveries over a multi-year horizon, although not necessarily on a yearly basis. I mean, they're really making it easy for Wall Street, aren't they? Just want to take a quick moment to thank today's video sponsor, Athletic Greens AG1, which I've been taking myself now for more than a year and a half and feel absolutely amazing. If you guys would like a free 1-year supply of vitamin D and K2 plus 5 travel packs, head to athleticgreens.com/SMR. I swear by this stuff. It's had a massive impact on my well-being, my mood, and most important of all, my energy. Most of you guys will know by now, I'm obsessed with my health. This is why I'm not a fat motherfucker. I do everything I possibly can to optimize my health and energy. I track my sleep, look after my health, I move my body, I do what it takes. And Athletic Greens AG1 is the biggest bang for buck, covering the most bases in a single daily ritual. Athletic Greens AG1 has an epic mix of multivitamins, minerals, probiotics, and adaptogens to help with stress, and plenty more, including things to promote gut health, immunity, energy, and overall well-being. Did you guys know that your gut health can affect just about every other aspect of your well-being, including how you feel, your levels of energy, and, believe it or not, your mood? Not even kidding. Athletic Greens AG1 is packed full of probiotics and prebiotics, plus plant-based enzymes to help with digestion. It also supports immunity with vitamin C, zinc, and plenty of functional mushrooms. No, not those kind of shrooms, unfortunately. The biggest effect I personally found from Athletic Greens AG1 within a couple of weeks of starting taking it, nearly 2 years ago now, my afternoon fatigue vanished. Previously, I was starting to feel tired and lethargic around 3-4 in the afternoon. I thought I was just getting old. It turns out, no, I just wasn't taking Athletic Greens AG1. Athletic Greens AG1 also helps with recovery. Just to recap, Athletic Greens AG1 is packed with 75 high-quality vitamins, minerals, and whole food source nutrients. It really is comprehensive nutrition in a single scoop. I take this every single day. It promotes gut health, supports immunity, boosts energy, and loads more. Best of all, there's a 90-day money-back guarantee. You have nothing to lose, plenty to gain. So what are you waiting for? Use the link in the pinned comment or head to athleticgreens.com/SMR and unlock your offer. 1 free year supply of vitamin D3 and K2, plus 5 Athletic Greens AG1 travel packs. If you want to optimize your health, mood, energy, and well-being, you got to give this a try. I absolutely swear by it. Let's run through my notes, the highlights from the earnings call itself. Elon's opening remarks, Elon emphasizing it was Tesla's best year ever on literally everything that matters. Surprise, surprise, and spoiler alert, the same will be true next year and next year and next year, and you guys have already heard the spiel. Excuse the typos in advance. Records, despite incredibly challenging year with forced shutdowns, high interest rates, and many delivery challenges. Regarding demand, which I knew would come up a million times on the call, and I also predicted ahead of time exactly how Tesla would answer. Thus far, in January, we've seen the strongest orders year to date ever in our history. Orders are coming in at almost 2 times the rate of production. Tesla's already had to raise the Model Y price a bit in response to that. As Elon points out, price really matters. And a vast number of people want to buy a Tesla but can't afford it. Price changes make a huge difference to the average consumer. Have you guys ever heard anyone say something along the lines of a linear decrease in price will cause an exponential increase in demand? Like, I don't know, you drop the price of a vehicle about 10-15% and the demand doubles? Yeah, no, I've never heard that before either. A few fairly obvious things being stated, including the fact that the costs in Austin and Berlin are dropping commensurate with production ramps, as in, the more volume they produce at each factory, the lower the cost per vehicle produced. The energy storage growth is accelerating, and that is an understatement. Elon emphasized the 3 pillars for sustainable future: electric vehicles, solar and wind, plus stationary storage. And a quote, "We want to keep making and selling as many vehicles as we can." Tesla also confirming they believe they can continue to do so with industry-leading profit margins. And once again banging the drum that over the long term, manufacturing will be Tesla's most important strength. Some comments from Zach Kirkhorn. In 2023, Tesla will be moving forward aggressively, leveraging strength in costs. Customer interest, as we expected, remains high. Regarding cost reductions, Tesla is massively increasing volume, which improves efficiency. They're also simultaneously unwinding a lot of the cost inflation due to the plague, the shutdowns, and then the supply chain issues that resulted. And should have gone without saying, but it was said anyway, Tesla's recent price reductions are focused on the long term. Remember, the software component, robo-taxis. This is what a lot of Wall Street and a lot of investors are missing. But now, on to retail investor questions. By the way, this is just me. Does anyone else love the fact that the retail investor questions are answered before Wall Street analyst questions? Exactly the way it should be. So a question was asked about the fake news regarding Tesla demand. Oh, there's demand concerns. I've heard it a million times. It drives me f***ing crazy, but straight from the horse's mouth. We've already answered that question. Demand far exceeds production. We are making some small price increases as a result. Yeah, in case you guys didn't hear, Model Y price is already getting increased following the recent price discounts. Why? Too many orders. Again, linear decrease in price, exponential increase in demand. If only somebody could have told us this would happen before it happened. Another question was asked regarding the initial reaction to price reductions. Tesla confirming we've answered that as well. Clearly, a lot of people curious about price. Again, I actually predicted exactly what would happen on this earnings call a couple of days ago. And by the way, my predictions have panned out. I'm not even going to go there again, but I literally predicted exactly how this call would go down ahead of time. Will Tesla be able to take full advantage of the battery manufacturing credits in the US, which is about $45 per kilowatt hour? Quote, long term, we expect these credits to be very significant. And confirmation that with Panasonic, Tesla will be splitting these credits. Don't know if it's 50-50, unsure, but that won't include Tesla's own cell production. And in the future, these credits could be gigantic. Tesla's best guess, in terms of the battery credits alone, could be on the order of $150 to $250 million a quarter, increasing with battery volumes over time. And Tesla once again stating the obvious, that they want to use these incentives to improve affordability. Rather than making stupidly high margins, if Tesla can, they'll reduce prices of their products as a result of these incentives. However, they're only going to do so based on their ability to supply. As we see, if prices come down a little bit, demand can increase an enormous amount. Tesla may not be able to pass on all of these cost savings directly to consumers, but they will use these to drive costs down as appropriate, as long as wait times don't blow out to ridiculous levels. Tesla also confirmed that with their recent pricing adjustments, surprise the f***ing prize, they were looking at the tax incentives to consumers, the $7,500 credit, and made adjustments accordingly, as we all know. For some strange reason, the IRS didn't classify Tesla's SUV as an SUV, meaning that it didn't meet the price cutoff. They had to lower their prices on the Model Y specifically to allow consumers to be eligible for this $7,500 tax credit. Again, it's pretty obvious. Corrupt legislation, Tesla's not eligible. What do? Reduce the price. We all saw this coming. Another retail question. After the price cuts, analysts expect margins to drop below 20% and average selling price to $47,000. Where do you see ASP and gross margins after the price cuts? Tesla's response. Our current forecast, we believe will be above both of the metrics in the question. In other words, gross automotive margins over 20% and average selling price over $47,000. And an important statement from Zach here. We're most focused on operating margin. This is the right metric to be focused on. This is Tesla doing Wall Street analyst jobs. Hey guys, just focus on operating margin. Everything else is noise. Elon also pointed out that something smart retail investors understand but others do not. The future software sales, e.g. full self-driving software and others, after the purchase of a vehicle. Tesla's fleet is already millions of cars to which FSD can be sold at essentially 100% profit margin after the hardware sale. This again goes back to Tesla's willingness to adjust prices to sell through all their production simply to grow their fleet. Eyes on the prize. The software component is what really matters. It's embarrassing that Tesla's already making 2, 3, 4 times as much as the industry average profit margin just on the hardware, but that's not where their future cash flow is going to come from. I mean, it will be a component, but hardware profits will be dwarfed by the software component in the future. And somebody also asked and or had a cry about Elon Musk sharing his political opinions. You know, the brand damage, all the bullshit you're hearing in the media, which again is total horse shit, which I've debunked already, and Elon Musk pointing out the obvious. Again, not something I've also pointed out myself. Literally, Elon responding. Let me check my Twitter account. I've got 127 million followers. It continues to grow very rapidly. Something I've literally pointed out regarding this very topic. That suggests I'm reasonably popular. I might not be popular with some people, but my follower count speaks for itself. Twitter is an incredibly powerful tool for driving demand for Tesla. The net value of Twitter, apart from a few people who are complaining, is gigantic, obviously. I mean, it's embarrassing that anyone on the Tesla call needs to be wasting time spelling such obvious shit out. I literally talked about this a couple of days ago, maybe a week ago in my video. All this supposed brand image, yet Elon's follower count's increasing by many hundreds of thousands of people every single week. Don't be fooled by the small vocal minority of virtue signaling morons claiming that they hate Elon and they're not buying an EV that's made by Tesla because Elon bad. They're noisy, they're loud, but they're a tiny, tiny, tiny minority. They also don't matter in more ways than one. Wait, did I say that out loud? Nah. An epic piece of information, a huge insight. Tesla Insurance is already at about a $300 million annual run rate in terms of Tesla Insurance premiums, and 17% of customers are using Tesla Insurance in states that it's available in, but a little bit of additional context. Insurance is pretty sticky. A lot of people, after the fact, they buy their vehicle, they sort out the insurance when they buy the vehicle, and then they don't really think about it again. Tesla is finding the insurance attach rate on new vehicles is much higher than 17%. Regarding Cybertruck, Tesla confirming, expect production to start around summer, but Importantly, the start of production is always very slow. It increases exponentially. And Elon said, I wouldn't put too much stock on the start of production. Volume production, which is 2024, is what matters. Regarding energy storage and megabuck. Is that a Freudian slip or a typo or both? I think it's both. Megapack / also megabuck factories. I like that. I might use this in the future. Happy accident. We'll provide an update in the future, but it's something we're thinking about carefully. What is the fastest path to 1,000 gigawatt hours a year of production? And unfortunately, if you guys aren't aware, when I recorded the run through the highlights of the actual earnings report, this was before the earnings call. Of course, you'll just have to take my word on that, but I fucking called it. Regarding the 1.8 million target, is it somewhat more supply constrained than demand constrained? Elon laughed at the very idea. I mean, bro, I could have told you, I did tell you earlier in the same fucking video before the call. Our internal production potentially is actually closer to 2 million vehicles, but we're saying 1.8 because there always seems to be some force majeure somewhere on Earth. If it's a smooth year, we actually have potential to do 2 million cars this year. And curiously, and I mean really curiously, one of the most important things said on the entire call, we have other products, keyword products with S, plural, that's more than one of them, probably quite a few of them, in development. We're not going to announce them, obviously, but they're very exciting and will blow people's minds when reveal them. So $25,000-ish Tesla next-gen vehicle, maybe a gigantic van-esque robotaxi as well. So you got like a more compact vehicle that'll effectively work as a robotaxi, transporting up to 4 people at a time, maybe 5. Possibly a robotaxi van based on Cybertruck. Think of it like a mini bus. What else? Leave your guesses and speculation in the comments below. And we've heard this before, but it remains true. Tesla has the most exciting product roadmap of any company on Earth. We have more great ideas than we know what to do with, and this is absolutely true. You guys remember the old HVAC system? A few hints from Tesla here. During the call, they were suggesting that some of the products might surprise people, so probably not automotive at all. More on that in a moment. Quote, one cannot predict the short-term stock value, recession, people panicking, etc. But long-term, I'm convinced that Tesla will be the most valuable company on Earth, said Elon Musk, and I agree with him. The cost of lithium in 2023 will actually be higher than it was in 2022, so this is a headwind facing Tesla, but they have a lot of tailwinds happening at the same time. And a really, really interesting insight. Quote, our fleet, as in vehicle fleet, is starting to mature. We're gathering a lot of data out of that fleet on how we can bring some margin we didn't know about. One example given, Tesla is actually over-engineering their powertrains, and they've realized this. They're too good, unnecessarily good. They can actually reduce some costs here without actually affecting performance, durability, etc. at all. This is huge. And the only way that Tesla's learned this is by having a fleet of vehicles on roads for this long, doing this many miles. They can see, oh, these powertrains are performing way better than we expected. And something that a lot of people may not have considered, but it's valid. If the recession is super bad, it will actually lead to meaningful decreases in most of Tesla's input costs, which would lead to better margins. Elon confirming, I'm just guessing here, the reason. If the shit's hitting the fan, there's a recession, there's less people buying components, most automotive manufacturers are seeing their sales collapse. It's going to mean that Tesla can buy parts, materials, and so on much cheaper than they could otherwise. So a recession is the best thing that could possibly happen to Tesla, and simultaneously the worst thing that could happen to any other automotive company attempting to compete. Regarding FSD take rate, trend is improving, obviously. Elon once again pointing out the obvious, but something that pretty much everyone on Wall Street still refuses to acknowledge. Tesla is one of the world's leading AI companies. This is kind of a big deal. By the way, anytime Elon ever says this is kind of a big deal, he means this is the biggest fucking deal that ever dealed. We're seeing a lot of the world's best AI talent joining Tesla. Optimus Bot is going to be big. More on AI. As we get closer to solving real-world AI, we don't see anyone close to us. Elon says, most people don't know what I'm talking about, and he's absolutely right. This, a very important quote, this is the thing that has order of magnitude potential improvement in market cap for Tesla. Now, I'm not sure if he said orders of magnitude or order of magnitude, but in either case, just based on today's market cap, the most conservative interpretation of this, 10x Tesla's current market cap on the back of real-world AI, conservatively. Regarding 4680s, Elon said, I alluded to a number of future products. Those products would use the 4680 cells. When asked about Tesla's biggest competitors in 5 years, quote, we don't even know who would be a distant second regarding autonomy, which is the thing that really matters. Right now, I don't think you could see second place with a telescope. Now, for those who missed this is actually a reference to something Elon Musk said in a private investor document from Tesla back in 2011, in which he said, quote, second place should need a telescope to see us. More than a decade later, they do need a telescope and they still can't even fucking see Tesla. Elon Musk said this out loud. Admittedly, it was a private document, but since been leaked. That was their intent, to be so far ahead that second place would literally need a goddamn telescope to see them, and guess what? Even if second place was able to get time on the James Webb Space Telescope, they wouldn't be able to see Tesla. Tesla is that far ahead. Regarding Tesla in China, the Tesla China team is winning in China. Elon going on to say that China team is actually attracting China's best talent. They're smashing many of the local competitors. Very impressive sales. Quite an achievement for a foreign automaker. First 100% foreign-owned automotive manufacturing plant in China, Tesla's, and they're absolutely slaying it. Elon Musk asking out loud, what is the limiting factor for new vehicles? For the longest time, we've been constrained by batteries. We want new product introduction to occur when new product can use new supply without taking away from existing products. So the reason Tesla doesn't yet have a compact car, they haven't already begun ramping up the Cybertruck, they don't already have a van, and so on. They just don't have the battery cells to put in them. No point adding additional complexity, robbing Peter to pay Paul, taking battery supplies from vehicles you could have sold to consumers that are already selling like hotcakes and have insane wait times. No point introducing a new product, taking away supply from the vehicles you can't already make enough of, just to introduce a new product. It's dumb. So Tesla's new product introduction will be aligned with their cell capacity and cell supply. Also, we think Dojo will be competitive with NVIDIA's H1 by the end of this year and hopefully surpass it next year. Regarding the inference computer, and listen closely, ladies and gentlemen, some big clues here. Tesla's inference computer may have uses in products, quote, that may not have anything to do with cars. This has potential for products that aren't automotive. Now, what could these products possibly be? Good question. I'll leave that up to you guys and girls to speculate. I've got my own ideas, but I'd like to hear what you think. And regarding the hitting the fan and a massive recession, if we see a severe recession this year, cash is king. We're in a very strong position to get through a recession. We basically have no debt and over $20 billion in cash. Elon also pointing out, due to the insanity at the moment with interest rates, the $20 billion is actually earning quite a good amount of interest. So let's recap Tesla's epic Q4 and full year 2022 earnings. Records on literally everything that matters. Tesla's current order flow about double that of their current rate of production, which is a huge fucking problem. Spoiler alert, prices are going to be going up even more. You can count on it. So much for the demand concerns. Tesla expecting robust margins in excess of 20% this year, average selling prices over $47,000 a pop, hinting at a number of new products, including some that aren't at all related to automotive. Coming soon, we'll hear more about those at Tesla Investor Day in about a month's time, and Tesla stock itself absolutely surging after their quarterly results. For real though, Tesla stock after hours up 5.47% as I record this. For some reason, I kind of feel like maybe 24 hours ago, I heard an analyst making a bet advising investors to wait until after earnings to buy Tesla stock because he thought it would probably come down a bit. I did acknowledge that it's certainly possible, after all, anything could happen, but I also pointed out, if like me you believe Tesla stock is absurdly cheap as it stands, why introduce the unnecessary risk, the hope that the stock will come down further after earnings when you can be buying today at what I personally believe to be bargain basement prices? I think it was a fair question at the time, and I think we've just learned the answer. Probably not a winning strategy. And just so we're clear, despite the after hours surge of 5.67% and counting, I still think Tesla is far and away the best risk-adjusted opportunity that I'm aware of in the stock market, and it is absolutely no contest. Don't forget, if you'd like to feel and perform your best, you've got to give Athletic Greens AG1 a try. Use the link in the pinned comment or head to athleticgreens.com/SMR and thank me later. And lastly, if you'd like to unlock more content, head over to Patreon with the card in the corner or the link in the pinned comment. Over 280 exclusive videos and counting fast. So, see you over on Patreon. Love ya.